Benefits of a 15-year mortgage. When you're buying or refinancing a home, it's likely your lender will present the most common home loan today, which is a 30-year fixed-rate mortgage. This simply means if you make the scheduled monthly P&I payments over the amortization term you choose for your home loan, in this example it's a 30-year, then your home will be paid off in 30 years or in that respective time frame. However, a lot of people we talk to want to explore paying off their home in less time. There are a few different ways you can go about doing this, one of which is choosing an amortization option with a term that helps you achieve your goal. Generally, you can opt for a 10, a 15, a 20, a 25, or a 30-year amortization option when taking out a home loan. Today, I'm going to run through the benefits of a 15-year fixed-rate mortgage and give you a few things to consider before you commit to choosing one. Before we dive into the benefits of a 15-year mortgage, you may be wondering, what do I mean when I say fixed? That means your home loan interest rate is fixed and won't change for the life of the loan, as opposed to a variable rate, which means just that. The home loan interest rate could vary during the life of the loan. For this purpose, we're going to focus on a fixed rate mortgage. Okay, so let's get into it. What are the benefits of a 15-year mortgage? Well, here are a few. You'll pay off your home loan faster. You'll build equity faster because a portion of your payment is actually increasing, which means that you're going to reduce your principal balance faster. Typically, interest rates are lower when compared to longer amortization options. The total interest paid is lower on a 15-year fixed rate loan than what it would be, let's say, on a 30-year loan. This equates to paying less dollars and can be astonishing once you see the actual dollars saved. Let's take a look at an example. This analysis is actually going to show 4 different options. I know, right? Like you're like, hello, we're just talking a 15-year fixed rate, but there's so much more that goes into this than just the amortization. So option 1, this is going to show you a true traditional 30-year fixed rate mortgage. I'm using a $600,000 purchase price across the board here and assuming a 20% down payment to make it easy. Option 2, I'm going to show a 30-year fixed rate mortgage, but paying additional $1,200 per month to actually pay that loan off in 15 years if that's the goal. Option 3, this is where we get a little bit crazy and think outside the box, but based on your situation, it actually may be a great option. And here we're going to show a 30-year fixed rate, but instead of paying the additional $1,200 a month to have that home loan paid off in 15 years, we're actually going to take that $1,200 a month and put it into an investment that is earning, for at least this example, a 4% return. And you're going to be shocked at what happens to that $1,200 a month at the end of 15 years. And then option 4 is the 15-year fixed rate option. Okay, so let's dive into it. So you're going to see the payment on the 30-year, and this does include an estimate for homeowners insurance and property taxes. I'm using the same amount across the board in each scenario. So the total monthly payment on the 30-year is $31.20. Now we go the 30-year, but paying off in 15-year, it is going to take the total monthly payment to $43.20 a month. So that's still giving you the luxury of being able to pay that loan off in 15 years, but now you're not committed to the 15-year fixed rate. We're going to talk about more of that in a second. Now the 30-year, again, the payment's going to be the same. It's still going to show you a house payment of $31.20, but instead of paying the additional $1,200 towards your principal, now we have that $1,200 invested in some type of investment account, again, earning a 4% return, which is kind of on the lower side of what our country's seeing, but I like to be conservative with these numbers. And then option 4, it's showing you a total payment of $41.90. So let's chunk it down. Let's say, so in reality, if I'm going to commit, like column 2 shows, to paying an extra $1,200 a month towards the principal to pay this off in 15 years, why wouldn't I just do the 15-year mortgage? Well, the difference is that if you opt for a 15-year mortgage, you're stuck in that 15-year mortgage. So if that payment feels like you're stretching or you're not 100% confident that you can pay it, then you may want to opt for something that's similar to column 2, which is take the 30-year. Yes, your interest rate in this scenario is about a 0.5 point higher, But in reality, it gives you the flexibility to pay the lower payment, and you can still pay it off in 15 years just by applying extra money towards the principal every month. And the net difference between the two options is roughly less than $200. So like if we really look at column 2 and column 4, it's $12,000 over the life of the loan for 15 years that you're paying to have the luxury of being able to truly amortize over 30 years and still pay it off in 15. So it's one of those kind of scenarios that it all comes down to your individual particular situation. And this is what's so hard about home loans and when you're out there searching, because what is relevant to you may not be relevant to me or our parents or our neighbors. We've got to dive deep into your particular scenario. A lot of that comes down to your age, how much you already have in some type of retirement or investment account, and really what your goals are. Where are you with your income? Where are you with your employment? Are you just starting out, just graduated from college, maybe have zero money in savings? Maybe you're getting ready to retire and you know your income is going to change dramatically. The point is there is not a one-size-fits-all type of response when it comes to mortgage lending. Now for the cons of a 15-year. Yes, all loans have pros and cons. What are the cons of a 15-year fixed rate mortgage, you might be asking? Well, again, you're committed to that higher monthly payment for the duration of the loan. You don't get to decide 2 years into it that you want to go back to a 30-year without refinancing. Your debt to income ratio will need to support the higher payment for you to be able to qualify for that home loan. Depending on your scenario, your age, again, your assets, the duration of your income, a 15-year mortgage may not be the best strategy for you. If you're stressed about that higher payment, you may want to opt for the longer amortization that reduces your payment and you're comfortable committing to, such as that 30-year mortgage. Then use a payment calculator or talk with your mortgage lender to find out how much more you would have to pay to, in fact, pay it off in 15 years if that's your goal. Yes, it's highly likely that your interest rate will be higher on a 30-year fixed rate than a 15-year fixed rate, but you'll still pay less in interest over the life of the loan if you paid the additional monthly towards the principal balance. This gives you the flexibility which can be important in life. For example, what if your current income allows the higher payment and you opt for that 15-year fixed rate mortgage, but in a few years something changes in your income scenario? If you chose that 15-year fixed rate, you are bound to pay that higher payment. However, if you chose that 30-year fixed rate and you have been paying additional towards your monthly principal, you could always stop paying the additional towards the principal until you can afford to resume that total principal reduction. In this case, you would keep the minimum payment based on that 30-year mortgage and you wouldn't have the additional stress of that higher payment. On a side note, please be careful of putting so much money towards paying off your home loan that you don't allocate funds for other retirement or investment goals. I can't tell you how many people I've talked to over the years that have focused so heavily on paying off their homes, but they didn't have any other assets and then they struggle to afford life. Depending on your age and your income, you may want to explore taking out a 30-year fixed rate option and allocating those funds that you would be paying on a 15-year to actually invest. An investment that actually has the ability to earn some type of return and grow over time. This is shown as option 3 in the analysis. Are there benefits to a 15-year mortgage? The actual answer is it depends. It depends on your financial situation and your goals. When exploring your home loan options, it's important to evaluate your individual financial goals and look for an experienced lender that can help you do so. Together, you can compare the cost, potential savings, your risk tolerance, your other assets, etc. I recommend getting a side-by-side comparison like this tool that can really dive into the different options so you can make the best choice for you. Helping homeowners evaluate options and understand how mortgages work is our mission and passion. If you have questions about a 15-year mortgage or home loans in general, please reach out or leave a comment below. Don't forget to subscribe to get the latest scoop on home loans. Until next time.